Today we're going to be talking about indexed universal life insurance, commonly known as IULs, and specifically talk about why they're usually a bad idea for most people. Welcome back to Life Insurance Explained. My name is David Duford, where we break down the fine print about how life insurance works so you can find the best policy for you and your family. So let's take a deeper look behind the Index Universal Life Insurance sales pitch, because there are serious downsides that, bottom line, most salespeople do not want to admit. Let's begin. What is an Index Universal Life Insurance policy? An Index Universal Life Insurance policy is a type of permanent life insurance that combines a death benefit with a cash value component. That cash value is linked to the performance of a stock market index, something like the S&P 500. But to be clear, you're not actually investing in that market. Instead, the insurance company gives you a portion of the market's gain, usually capped at 10 to 12%, and protects you from losses with a 0% floor. Sounds nice, right? Well, here's the catch. You're also getting hit with layers of fees, policy expenses, and moving parts that most people simply do not understand. The 5 biggest problems with IULs. So let's break down the 5 biggest reasons why indexed universal life insurance is often a bad deal, and back each one with real life sources and industry data. The fees are insanely high. You don't see these or hear about these fees in the sales pitch, but bottom line, IULs are packed with hidden fees, some of which includes the cost of insurance, which rises as you age, administrative fees, rider charges, and sales commissions. And while your return might look nice on an illustration, in the real world, it may be eaten alive by fees. Investopedia notes, many IUL policies charge a dizzying array of fees, which can significantly reduce returns, especially in the early years. Number 2, returns are overpromised and underwhelming. Now, there are some agents who love to show projected returns of 7% or more and imply that you'll ride the market safely without risk. But here's the reality. First, you're capped most likely between 8% and 10% with most products. You do not earn dividends, which make up a big part of the index returns. You're still paying fees, and your participation rate may only be 80% to 90%. As the white coat investor puts it, you don't get anywhere near the market returns due to cap rates, loss of dividends, and insurance costs. Number 3, complexity equals confusion, which equals risk. Index universal life plans aren't set it and forget it type of policies. Instead, they are very complicated products with flexible premiums, changing costs of insurance, variable cap and participation rates, index crediting rules, loan mechanics, and risk of lapse if not properly funded. And most consumers, in my experience, don't truly understand these mechanics, which often leads to disappointment and often financial loss. Even insurancenews.net, a pro-industry outlet, calls IULs a persistent headache for regulators due to mis-selling and complex internal structure. Number 4, loans can backfire. One of the biggest sales points of IULs is this: borrow from your policy tax-free in retirement. But what does the fine print say? First, you do pay interest on loans. Second, if the market underperforms or fees climb, your loan balance can outpace growth. And third, if your policy lapses with loans, the IRS treats all borrowed money as taxable income. Bottom line, you can end up with no death benefit, a huge tax bill, and 0 retirement income. This tax-free pitch can be dangerous if misunderstood, and it's often massively oversimplified in agent presentations. Number 5, most policies lapse before the insured dies. So here's the brutal truth. According to Society of Actuaries and LIMRA, IUL lapse rates rose significantly during the pandemic, unlike other policy types. Consumer Advocacy Center reports that roughly 4.3% of IULs lapse annually, meaning many policies never pay out, and many consumers lose their entire investment. This happens because people underfund the policies, loans reduce the cash value, and the cost of insurance balloons with age. And when the policy lapses, you're left with nothing. And that may be after decades and decades of paying in. Who might an IUL work for? Now, let's be fair. There are a few scenarios where an IUL could work. For example, you're very high income, you've maxed out your Roth IRA, 401k, and other tax shelters, and you can overfund the policy by a lot. But for the average middle-class family, it's usually a bad deal sold as a magical solution. Better alternatives. If you're looking for tax-free retirement income, consider the following options. There are Roth IRAs, HSAs, 401k with Roth options, and index funds or ETFs in a taxable brokerage account. Now, if you're looking for life insurance, go with term life insurance if you're younger. It's simple, it's cheap, and does exactly what you expect. And go with whole life insurance if you're looking for a death benefit that will never cancel due to age or health, and you're looking to pay for things like final expenses or any final debts that you cannot outlive. So don't fall for slick pitches and cherry-picked illustrations. IUL sound good until you read the fine print. If you're considering one or already have one and want a second opinion, give us a call at 888-626-0439. That reaches my company, The Dig Agency. We help people across all 50 states, including Washington, D.C., with their life insurance questions. And make sure you hit the like and subscribe button if you enjoy this kind of content and want to see more. Thanks for watching.